Hi, everyone. Welcome to your latest Carson's Take 5. Ryan and Sonu on location in beautiful, where are we? So we're not San Diego. We're La
Del
Jolla. Where
Mar.
are we, Sonu?
Del
I don't even know where
Mar.
I am.
Slightly north of San
Del
Diego.
Mar.
So it's nice. We'll put it at that. It's really nice.
It is a little bit warmer than where we usually are. But, what's not so warm, Sonu, is tech stocks. So today we're going to talk about the tech wreck. There's a lot of confusion, worry, and concern. AI, as great as it is really disrupting, the software stocks in general. That's kind of falling into some of the business investment companies. We're not going to get too specific on individual names, but just know that there's areas that you didn't think would be impacted by AI, but they have been. And as a result, technology has been by far the weakest group so far this year. Software, very weak subgroup. How worried should we be about the tech wreck in 2026?
It was only 2 months ago, everyone was talking about whether we should be worried about a bubble. Now we are talking about the other side of that. But, at the time we poked holes in the so-called bubble theory. And I think this sell-off, if you want to call it that, maybe a wreck, is probably a little overwrought, a little overdone. And here's a stat, right? Since the end of October, right? So last 3 months, the S&P 500 is just about flat, slightly negative. And this gets to the idea of, why you should be diversified too, right? The S&P 500 is flat. But if you look at the technology sector, it's down 4, 5, 6%. Now, the technology sector is about, 30% of the index, if you include things like communication services, which is where your Alphabets and your Metas of the world sit, right? Not a recommendation. Those are the sectors in which they sit. That's about 50% of the S&P 500. That's a big weight. Now, if that 50% is down, and if you're concentrated in that 50%, that's not a good thing. But the rest of it has done well, Ryan, right? Every other sector, whether you look at industrials, some pieces of healthcare, energy stocks, material stocks, these are stocks that would be tied to the business cycle. And the fact that they're doing well tells you that the economy is actually doing fine. It's growing on trend. So there are positives here. Plus, my big takeaway is this is why you need to be diversified. You shouldn't be concentrated.
So I'll chime in. Great stuff there. And that's what happens. We've seen large cap tech do very well for multiple years in a row. We get to work with advisors and clients all around the country. And then, when something's doing really well, this is kind of why we talk about rebalancing, why I say don't always chase this shiny object. Because, again, there's something called the S&P 500 equal weight. Like the name would suggest, all 500 stocks count the same. So the smallest guy counts the same as something like NVIDIA. Well, that literally, let's see, today starts on Wednesday. On Wednesday, that closed at an all-time high. So on Wednesday, like 350 stocks in the S&P 500 were higher. Yet the S&P was down. Tech was down close to 2%. Again, because those other smaller, kind of underloved, underappreciated areas are lower. There's no question, though. If tech continues to sell off in his week, that's going to kind of hold back the market in general. But again, that's why we look around the globe. I mean, hey, I'll say one more than back to you. We like Europe. We've talked a lot about Developed International as a nice potential place to diversify your portfolio. Last I checked, Europe, do they have some tech? Of course they have some tech. But they are, there are a lot of industrials. There are a lot of materials. There are a lot of healthcare. That's a lot of what Europe is. And that's why financial, good, thank you for getting me out. I was just tongue-tied there. Financials, that's a reason, again, maybe to, quote unquote, avoid tech, but look at some other areas. What else you want to talk about here, Sonu?
On the topic of tech, right? We're in the middle of earnings season. When we wrote our 2026 outlook, Ride the Wave, essentially we're talking about, yes, you want to ride the AI wave, but you want to be careful of how you construct your portfolios. You want a diversified portfolio. Now, one thing a chart we put in there was an estimate of how much CapEx spending a lot of the big tech companies will do this year, right? And it amounted to about 1.6% of GDP, about 500 billion thereabouts, right? Last year, it was about 400 billion, slightly under 400 billion. And this year, we are supposed to be, going up. Guess what, Ryan? After these earnings calls, all these companies, one after the other, are telling us they're going to spend even more than that. So when the clock sets on 2026, or maybe I should say when the sun sets on 2026, total CapEx spending by all these large tech firms into AI will maybe about 2% of GDP. And just 2 months ago, we were thinking it would be about 1.5% of GDP. And by the way, why I bring this up is, look, one company's spending is another company's revenue and profits. That boosts in aggregate profits. And that's why you want to still stay invested. That's why we're positive about the stock market for the year.
Well said. Again, we'll probably wrap this up soon, but we're in the middle of earnings season. Maybe not even middle. We're probably rounding third at this point. A lot of big companies. And tech in general has had really strong earnings. Here's the thing, though. Some of the forward guidance has been a tad on the weak side, and those stocks have been punished. Again, I say the stock market, it doesn't care about what's necessarily, good or bad. It's about better or worse. Those expectations, everyone, for technology and large cap tech AI, they were awfully high. Even though these companies are making a ton of money, they haven't beat kind of that high bar. Whereas you've got other underloved, underappreciated areas that clearly are. And again, like we said, that's why we preach to keep a diversified portfolio. That's why we still think this is a bull market. We still think stocks will be a good deal higher before the end of the year. And even tech probably comes back a good deal. Sonu, we probably hit about the end of the road. You and I are busy out here in California trying to work on our tan very soon. Anything you want to wrap this up with?
No, I think the message of this is, you want to ride the wave, like we said in our outlook, but do it with a diversified portfolio.
Yeah, well said. One more thing. I've said this a lot, but we're going to say it one more time to wrap it up. Volatility is the toll we pay to invest. Our Chief Investment Officer, Burt White. Oh, no, CEO, sorry. Chief CEO, Burt White. I think maybe the CIO too. Who knows? Anyway, Burt White, our boss, let's go with that. Burt, our boss, says volatility is the toll we pay to invest. And it's important. I mean, we understand this week's been uncomfortable. Last couple of weeks, if you have a lot of tech, if you potentially have some crypto, some of the former high flyer stuff, it's been hurting. But if you're in some of the small caps, under love stuff, it's actually doing well. So there's definitely different markets out there. We still think this is a bull market being led by higher earnings, being led by higher profit margins. This is just one of those rough spots that we have. February, I don't make it up. I just report it. Tends to be a banana peel of a month is what I've called it before. You tend to have a little weakness. I'm not shocked by some of this February weakness, but we think we're going to get through it, and this is still a bull market. Everyone, this is again with your latest Carson's Take 5 live on location from Del Mar, California. Let's talk about the tech wreck. See you by next week. Take care.